In this video, I'm going to show you how we calculate daily gamma-based levels from the options chain, share them every morning before the market opens in our Discord, and then use our TradingView PacePack indicator to instantly plot those levels on the chart. And no, you do not need to trade options to use them. These levels are translated directly into futures price levels you can actually trade. So if you trade futures, this is already highly relevant. And later on, I'll also mention what we're building next, because we're working on translating these levels automatically into index levels for CFD traders as well. But before we get into the indicator itself, here is a quick breakdown before we dive into the indicator. If you don't give a shit, then skip this part and move to the section where we showcase the indicator. Gamma levels come from options positioning. In simple terms, they help us identify price areas where the market is more likely to react because of the structure sitting underneath the surface. That is what makes them different from random support and resistance. Now let's break down the main levels. The call wall is usually a major overhead area tied to strong call positioning. In many cases, this can act as resistance, a magnet, or a place where price slows down. The put wall is typically the opposite. It is often a strong support area tied to put positioning, and it can be a place where price stabilizes or bounces. Then you have the combo levels. These are additional important gamma-derived levels that often act as secondary support and resistance. They are not always as dominant as the main walls, but they still matter and can create solid reactions. The large gamma levels are exactly what they sound like, areas where gamma concentration is especially high. These are often the levels that carry the most weight and create the cleanest reactions. Then we have zero gamma. This is one of the most important concepts. Zero gamma is the area where the market can shift from one type of behavior to another. In simple terms, it is the line where dealer hedging dynamics can start changing, and that can completely change how price behaves around the session. And then there is the volatility trigger. This is a key level where volatility can start expanding. If price starts pushing through that area, the market can become much more active, much more directional, and much less stable. Now let's talk about positive gamma and negative gamma, because this is where it gets really useful. In a positive gamma environment, price tends to be more stable. Moves often slow down around key levels. The market can get pinned, and mean reversion becomes more likely. That means support and resistance behavior often becomes cleaner. Price is more likely to react, stall, or bounce around these zones. In a negative gamma environment, the market behaves very differently. Moves can become more aggressive, breakouts can extend harder, and price can travel faster once key levels start breaking. So instead of a level just causing a pause, it can become the starting point of a much larger move. That is why these levels are so useful. They do not just show you where price might react, they also give you context for how price is likely to behave around those levels. If price is above a major level, that level can act as support. If price is below it, that same level can act as resistance. If price is sitting near zero gamma or volatility trigger, that can be a warning that conditions may shift quickly. So the goal is not just to look at the line. The goal is to understand what that line means in the context of market structure. And that brings us to the indicator. Every single morning before the market open, we run our algorithm on the options chain and calculate the key gamma-based levels for the day. We identify where the important walls are. We identify the large gamma concentrations. We identify zero gamma. We identify the volatility trigger, and then we package all of that into a simple pace pack. That pace pack gets posted every morning in our exclusive Discord channel before the market opens. From there, the workflow is simple. You go into the Discord, you copy the pace pack, you open the TradingView indicator, you paste the levels in, and instantly the levels appear on your chart. So instead of spending your morning trying to map everything manually, the work is already done for you. And this is where the real edge starts to show. Because now you are not coming into the session blind. You already know where the major support and resistance zones are likely sitting. You already know where price may stall, you already know where price may bounce, and you already know where a move can start expanding if the market enters a more volatile regime. The first example. I pasted the gamma exposure levels pack of this day into the indicator. CVD and F short combo printed on the delta pressure engine. Volatility trigger hit twice and went up. Zero gamma hit and went down. Breached zero gamma and rejected on L3 moderate level. Hits volatility trigger again and spikes upwards. Barely hits zero gamma and goes down. Breaches zero gamma, retests it as flip support. Breached L3 and rejects on the core wall. Mean reversion downwards, breaching all support gamma levels. Then ANF prints a long signal on the delta pressure engine, goes up and rejects on the zero gamma again. A lot of insane trade opportunities this day. The hedging levels were respected precisely as it should. First, you could have gone short here on the short printed CVD ANF signal, then long here twice on the volatility trigger, a short here on the zero gamma, a long again on the volatility trigger, a short on the strongest level of them all, the call wall, then a long on this ANF signal from the delta pressure indicator, followed with a short on the zero gamma again, and then call it a day. Here, a few examples of other days respecting the gamma levels insanely well, including the delta pressure indicator. The levels just make so much sense. It's not just a strategy based on a look. Gamma levels are price zones derived from options positioning, especially from where large amounts of calls and puts are concentrated. What makes them different from normal support and resistance is that they are not just based on chart history. They are connected to real dealer hedging activity in the market. When price moves toward one of these levels, dealers often have to buy or sell the underlying market to stay hedged. That creates actual order flow. And that is why gamma levels can be so powerful. Normal support and resistance works because traders remember certain highs, lows, and reaction zones. Gamma levels can work because there is mechanical buying or selling pressure behind them. That is the big difference. A normal level says, price reacted here before. A gamma level says, price may react here again, and there may also be forced hedging flow at that exact area. That is why levels like the call wall, put wall, zero gamma, and vol trigger are watched so closely. In a positive gamma environment, price often gets pinned, slows down, and mean reverts around those levels. In a negative gamma environment, once price breaks through them, moves can accelerate fast because hedging starts pushing in the same direction as price. So gamma levels are often stronger than standard support and resistance because they reflect the structure underneath the market, not just what is visible on a chart. They can show where price is likely to stall, reverse, get pinned, or even explode through a level. What these levels give you is a framework, and if you have a good framework before the session even begins, your decision making gets a lot cleaner. You can use these levels for entries, you can use them for take profit targets, you can use them for invalidation, you can use them to stay out of bad trades, and you can use them to understand whether the market is more likely to be stable and mean reverting or fast and directional. That is the real value. Not just having lines on a chart, but understanding what those lines actually represent. So to recap, we calculate the levels every morning using our algorithm on the options chain. We post them before the market opens in our exclusive Discord. You copy the paste pack, you paste it into the TradingView indicator, and then you can trade those translated futures levels with structure already built in. And again, one more time because this part matters. You do not need to trade options to use this. These levels are already translated directly into futures price levels you can actually trade. And this is only the beginning. We are also working on taking this a step further by automatically translating these levels into index levels for CFDs as well. So if you trade CFDs, that is something coming down the line that we are very excited about. If you want daily access to these levels before the market open, and you want a more structured way to approach the market instead of guessing, check out the Discord and start using the GEX levels pace pack indicator the way it was meant to be used.